Financial freedom seekers, Simon Dixon here today, and today we're going to be talking about the decoupling and whether Bitcoin can survive a stock market crash. So to answer that question, most people are thinking that Bitcoin shouldn't be correlated to the stock market, and if it is correlated to the stock market, isn't it just dependent upon fiat money printing, low interest rates, and all sorts of stuff? So today we're going to be answering that question. To answer that question, let me just give you the answer right now. Is Bitcoin and the stock market correlated? The answer is yes, yes, and no. So let's go through each of those. And to answer that, we're going to have to look at the short term, we're going to have to look at the medium term, and we're going to have a look at the long term. Now, to answer this question, I could pull up a bunch of charts and I could do a bunch of analysis, but I want to just give you the macro concepts so that you can understand the way that my head thinks, so that you can utilize that in order to be more empowered to make better financial decisions for yourself, rather than just following a bunch of blind charts and blindly following what you might consider to be financial advice. I want to instead give some education so that you can understand and untangle what comes up. So let's have a look at the short term. In the short term, the price of stock market and the price of Bitcoin is driven by the exact same thing: the emotions of fear, greed, and speculation. I know because I used to work as a market maker on the London Stock Exchange alternative investment market, and 90% of traders lose money at the expense of the 10% of insiders. Insiders drive the market manipulation behavior, and then everyone else follows and they try to quickly make money. I'm sorry, I am a shareholder in Robinhood, but through companies like Robinhood, I'm also a shareholder in many of the crypto exchanges, and I'd much rather just own stocks and shares in the cryptocurrency exchanges because they make all the money from all the short-term speculation. When things go up, things go down, and stay on top of all that stuff. So having been an insider on both the traditional markets and the Bitcoin and crypto markets, I can tell you that trading is a losing game, creates taxable events. But anyway, people want to gamble, they will continue to gamble and still think that they are involved in the industry by being a trader. But fear, the emotions of fear, greed, speculation. If you choose to trade, I used to be a trader on the markets. Let me give you a gem if I can. You only need to get it right 50% of the time. You just use to do money management, and to do that, you got to perfect your trading psychology, which is why 90% can't do it, because they think it's all about finding the next flag pattern, technical analysis, or ascending triangle and candlestick pattern. All of those are just summations of the emotions of fear and greed that almost the best in the world get wrong half of the time. And the reason that they can consistently be some kind of profitable once they get there is because they've implemented a way of managing losses and pushing gains, and using trading psychology as the mechanism in order to do that by the side. But anyway, Bitcoin and stocks are driven by insiders, manipulation, the emotions of fear and greed. Anybody that is somebody that can move prices in those markets, they do it over the counter. So I was a market maker on the London Stock Exchange, and we would get a call from Goldman Sachs, and Goldman Sachs would say, I'd like to work this order, and we would work that order off books over the counter. I'm a shareholder in many of the cryptocurrency exchanges, and those that have vast amounts of Bitcoin and Bitcoin whales, they don't go to exchanges and place orders on order books. They contact their over-the-counter trading market, and they work orders over time. And so most of the orders, the big orders, are done by putting together buyers and sellers off exchange, but it's the short-term people on the exchange that determine the price, as opposed to the long-term over-the-counter, because they are investors, and so most of the volume happens off those exchanges. Okay, so short-term, you'd expect Bitcoin, and the same emotion that drives someone to buy Bitcoin short-term is the same emotion that drives someone to speculate on stocks short-term. They're driven by fundamental news. They come in and out, they capitulate, and all the other things, and the emotions of fear, and greed and essentially fiat thinking. They're using stocks as a mechanism in order to accumulate more fiat, and they're using Bitcoin as a mechanism in order to accumulate more fiat. The insiders manipulate the market, and then the rest follow by trying to trade and beat the market on the exchange. Right, that's the short term. Medium term, it is more the fundamentals and the longer term trend of people seeing it as savings. And what is driving savings? Well, two forces. Those that save in Bitcoin, they are driven by their understanding that they believe the demand for money that you can own in your own pocket, let's call it a Swiss bank account as it were, but be able to have that with you and transport that all around the world and be able to own it with no counterparty in the middle is driving one of the demands for Bitcoin. The second, as I say all the time in every video, is the ability to spend it peer-to-peer, digitally and globally, something that's very hard to do with a physical asset normally. So that was one of the big inventions. And the third is a deflationary currency. That's a geeky way of saying when governments print more money and it causes inflation, which destroys the value of your savings, you look for somewhere to combat that because you want to work hard and have what you save in worth more than it's being destroyed with inflation. Now, savings accounts, bonds, they do not produce above inflation returns. And so therefore, in the medium term, people look to assets because we're all driven to speculation, because they have to see assets like Bitcoin and stocks as almost like a savings account. Now, that is very bad symptom of debt-based monetary system that drives everyone into speculation to beat inflation because they are taking on debt in order to consume or in order to speculate to beat inflation in the world's largest regulated Ponzi scheme called fiat currency. But having said that, you have to be driven to some kind of force, and so people use Bitcoin and stocks in the medium time in the same way they use real estate. They see it as a way of combating inflation. Now, there's a slight nuance here. The nuance is that they are both in the long term driven by the actions of central banks, but in different ways. And this is where you get the decoupling effect. Now, most people look at the short-term chart and say they're correlated, and then they look at the medium chart and say, oh, they're slightly decoupling. But we have only ever had, since Bitcoin's creation 13 years ago, a QE-led bull market with an interventionist policy by central banks saying that stock markets are not allowed to crash. So we have not, in our 13 years, seen evidence in the charts that would suggest what I'm about to say. But in the long term, my belief is, and my bet and my finances, and I also obviously hedge against being wrong, because I bet on central banks continuing to create central bank digital currencies, as well as Bitcoin producing the exact need why you should hedge against what the central banks and governments are doing. So looking at the long term is where you get the true understanding, and most people look at short-term markets in order to judge long-term and wonder why they get it wrong. The long term, the continuation of the stock market is driven based upon central banks continuing to do what they have done, which is not allowing the stock market to crash. How do they do that? Well, they continue to keep interest rates low, and they purchase stocks, either directly or indirectly through shadow banking products, where through quantitative easing, which is the process of a central bank creating money in order to purchase bonds, which is loans to governments, and also junk bonds as well, which is loans to companies through the bond market. Or indirect things like creating wealth effects through purchasing mortgage securities, and those mortgages are packaged up at an investment bank from the retail bank, from all of you borrowing money every time, and every time you borrow that money to purchase real estate, it pushes up the markets, and then there's a wealth effect that is then used by the stock issuer, i.e. a company like Apple, let's say, will then use its higher share price in order to borrow money on the bond market and then use that money to repurchase its stocks. And when it repurchases its stocks, it means that you get this feedback loop between central bank quantitative easing, low interest rates that allow people to borrow it cheap if they're connected and closest to the central banks or the investment banks. And therefore, stocks are driven by that. So that's why they are illogically uncorrelated to their profits in the long term, because they're really all driven by markets and low interest rates. So when interest rates go up, you tend to get a correction in stock markets. At the same time, a short-term correction in Bitcoin markets, and you start to see some of those medium trends come through. But in the long term, because of the funny economy that we have created now, where the stock market is dependent upon low interest rates and continued quantitative easing and continued money creation in order to use financial engineering in order to repurchase those stocks based upon using the fact that we have money that goes down in value, i.e. fiat currency, using the bond markets in order to combat that, is what drives the continual growth of the stock markets. So when you get a long-term reversal in those policies, i.e. if you get runaway inflation, then you have to put interest rates up to send people bankrupt that borrowed all the money so they can cool down the economy and prices go down slightly until they find the next borrowing wave and create new money every time new money is issued. And therefore, stock markets are a bet upon that continual process. Now, let's say that they decide to put up interest rates, and then that leads to the systemic risk in the banking system exposing yourself and banks going bust and creating a 2007 style event. Well, they do have that new tool, which is a central bank digital currency, which is injecting debt-free money. They have bills at the moment to create a central bank digital currency, Fed coin. They also have eCash, which is a bill for the treasury. And if you want to learn more about the different types of stablecoin, central bank digital currencies and all these money, check out the video that I created yesterday on eCash and the internal currency war between the treasury, the Fed and the banks in the United States. I called it a civil currency war. That continuation has to continue. Do I think that they will release central banks, digital currency to save the system? Yes, I do. And therefore, we get the protection of the stock market, even in systemic risk events and bank failures. But you will still get those short-term and medium-term trends. Now, here's where Bitcoin gets interesting. Bitcoin benefits because those are the fiat thinkers. Still, if you continue the same system, then people still purchase Bitcoin as a speculative asset as fiat thinkers. But if the opposite happens and you get quantitative tightening and you get the increase in interest rates, in the short term, you still get people saying, all right, let's take risk off, let's move to more savings products, rather than speculative products, and therefore you can have the same trend, but Bitcoin can still continue under quantitative easing and the markets that we have right now with increased or decreased interest rates, because it is based upon the demand for money you can own, money you can spend, and money that has a fixed supply. So let's think about that. What does quantitative easing do? Well, quantitative easing pushes money out there that causes a cost of living crisis and a feedback loop in terms of increased prices. And so therefore, people are driven into trying to find above inflation, and Bitcoin sits squarely in that. Now, let's say it goes to quantitative tightening and increase of interest rates. Then you'd expect short term people to say, all right, now the need for Bitcoin is no longer there. However, as we shift in quantitative tightening, it exposes the weaknesses in banking, and you get geopolitics that give people the reason to own their own money, spend their own money, and have money that has a fixed supply. So if we move to quantitative tightening, it drives us into bank failures and financial crises event, in which case you need money to go to an asset that exists outside the traditional financial system. So the whole key here is if you want to be a short-term trader and you try and get around these trends, then you've got to be a financial genius, a lucky and a gambler. If you get those gambles right, then you'll probably come back here when you want to build and protect your wealth longer term because it doesn't sustain itself. If you want to try and do all that crazy stuff that everyone tries to do, then try and get on top of all these different trends and predict them short term and try and buy Bitcoin at the right moment, sell stocks at the right moment, get the tax efficiency right, and then always try to get on the right side of these trends and see things, and also make sure you're an insider so you can see those that are pushing Bitcoin into the exchanges at the same time as doing over-the-counter trades, and the same in the stock market, and you think you can get ahead of all those hedge funds that have high-frequency trading and internet connections directly into the stock markets, and insiders that have the ability to manipulate crypto exchanges in the short term. If you want to get on the right, if you want to try and beat all those people, then feel free to continue trading. If, however, you just want to calm down, get on with your life, do what you need to do, and if you do that as a hobby, fine, take a percentage of it and do that as a hobby. But in the investing side, you've got to look at the long-term trends, and what I like is asymmetric bets. And an asymmetric bet is an above normal return with a lower amount of risk. And that's why Bitcoin benefiting from quantitative easing, quantitative tightening, increases in interest rates, decreases in interest rates, inflation, bank failures, is, in my perspective, a responsible thing for people to hold a percentage of their wealth in because of those long-term trends. And don't let the short term and medium, make you do things that I've seen over the last 13 years in the highest performing asset class in history. People end up with less Bitcoin than when they started. So the way to think about this is to make a few psychological shifts. So firstly, if you want to be the short-term trader, there's great literature on trading psychology. Don't try and get it right. Understand that mechanism on what drives markets, fear, greed, and then you have to get money management and psychology right. But in the long term, the way to think about this is driving yourself away from fiat thinking into Bitcoin thinking. I've covered this in many videos in the past. Fiat thinking is where you combine your spending account with your investment account, and as your assets decrease and increase in value, the psychology plays upon you, driving you to do stupid things because you're analyzing it in terms of paying your rent, paying your mortgage, and that is because you haven't separated what fiat does really well, which is stably in countries that don't suffer from hyperinflation, short term allow you to meet your expenses. But combining that with your savings is where everything goes suicidal and people get things wrong. And then they end up investing and saying, I can't afford my rent this month, so I've got to sell my Bitcoin, and get on the wrong side of short-term trends. So firstly, you've got to adjust yourself to Bitcoin thinking over fiat thinking, which means that when you have it separated, the lower the price of Bitcoin, the more you get to accumulate, the better. As it goes up, you feel good in fiat terms. And so that's the way to get on the right side of that. The other thing that you can do to adjust is, rather than valuing everything in dollars, value everything in gold. Gold has been a wealth preserver and not wealth creator, a wealth preserver for 5,000 years. So if you take the price of stocks denominated in gold, and if you take the price of dollars denominated in gold, and if you take the price of Bitcoin denominated in gold, you get to see a fairer picture that allows you to understand the longer term trends here. If you want to get a bit geeky, do it as a logarithmic chart so it takes out all the noise. Essentially, that just changes the axes. Don't want to get too geeky, but by pricing things in gold, it forces you to shift your thinking. By thinking in terms of Bitcoin accumulation rather than fiat accumulation, it drives you away from the short term and makes you think on the long term. And by understanding the differences between the long-term demand and the short-term is the key to really building and protecting your firm. So the answer to the original question, is there going to be a decoupling and can Bitcoin survive a stock market crash? The answer is short-term, they are coupled. Medium term, they can be coupled depending on geopolitics, but long term, they could be coupled based upon central banks continuing to do what they do, but they will certainly decouple when central banks destroy the system and we end up in any of the monetary renegotiations, or you either get that issuance of central bank digital currency to save the banking system, or you get free markets prevailing. Either way, expect short-term much volatility, and long-term, just look at the logarithmic chart over the last 13 years in Bitcoin. And I can't give you financial or investment advice, and I can't promise that the past equals the future, but a trend is a trend. So always remember, you are alive at one of the most interesting and exciting times in financial history. Some people are going to get hurt. Others are going to do incredibly well. And if you would do me a favor, like, share this channel, share it with people that you care about. And if you enjoyed this content, then hit that subscribe button, hit the bell symbol, hit all, and I will continue to release content that tries to get you the information you need to stay on the right side of financial history. As we have seen in times of financial weapons of mass destruction and weapons of mass destruction, it actually becomes life or death, depending on the geopolitics of your country. So I would like to get as many people on the right side of financial history so that we can make better decisions, because the world certainly needs more people that have some level of financial freedom in order to make better decisions and support other people in these times. My goal is to always do it with peace, love, and unity. And I'm gonna see you in the next video. Peace.